Thank you, and welcome everyone. It's really very nice to be here today and to have this time to have a conversation about the stage of the global economy. So I'm going to give you a brief overview of what are the sort of the major forces shaping the outlook and what are the key policy trade-offs that countries are facing right now, and especially emerging market economies. So let me start right away with sort of a summary slide on what's been happening in the last 3 months. We do these projections, this round of projections 4 times a year. The last one was in October. The October round is a more complete round of projections. The January one is a smaller projection. We call that an update, but it still gives us a lot of details on the global economy. And what we're seeing here is an economy that has been very resilient. You see on the left world real GDP growth, 2022 up until 2025. The dashed line is what we were anticipating as of our October round of projection, and you can see that this has been lifted up, so there's been more resilient growth. We're expecting about 3.1% growth this year, 3.2% growth next year. And this is in the context of a global economy that's been dealing with a series of pretty significant shocks. And whether you think about the impact of the Russian invasion of Ukraine, the reopening after COVID, the energy crisis, the surge in inflation. So there have been a number of things that led us in earlier rounds to be a little bit cautious about what we were seeing in terms of growth performance and be worried that maybe the global economy would slow down, and it has slowed down, but it has been also very, very resilient. Now, what we're seeing also in terms of when we look under the hood, when we look at this growth number, but we look where the growth was, what we're seeing also is a number of resilience in many different parts of the world. So the US economy has been growing more strongly than expected. You can see that in this middle figure here. China, which has been slowing down, but has been also growing a little bit faster than what was anticipated in our October round of projections. And many other large emerging market economies, Brazil, India, many Southeast Asian economies, Russia, have been doing better. The regions that have not been doing as well, one of them chiefly is the Euro area, been suffering the brunt of the surge in energy prices coming from the aftermath of the Russian invasion of Ukraine, and also tight monetary policy, and that has been weighing down on growth and continues to weigh down, and maybe even a little bit more than was anticipated earlier. The other piece of good news, besides the growth, the economy being more resilient, is inflation coming down faster than expected. You can see that on the right here when you look both at headline inflation and underlying inflation, what we call core inflation, excluding food and energy prices. And you see that here again, the solid line is below the dashed line. That's kind of the extent of the surprise revision, and inflation has been coming down faster. We're now expecting global inflation around 5.8% this year, coming down to 4.4% next year. So this is a better environment. This is one where we are now, there is a higher likelihood that the global economy may be able to bring down inflation back to central bank targets without having a global recession or even a recession in many parts of the world. And so the likelihood of a soft landing, as we call it affectionately, has increased. Now, that doesn't mean that everything is good. There are still a number of risks ahead of us, and our report and our update discusses some of them and lists some of them on the right-hand side. But these risks are a bit more balanced compared to previous exercises. So we are seeing risk that things could get worse, but there are also chances that things could get better, and it's worth acknowledging. So on the upside risk, we could, again, be surprised by the speed at which inflation is coming down. A lot of that disinflation is the result of energy prices coming down faster. And so we could, again, see some of that going forward. There could be a faster recovery in China. China, as I mentioned, has slowed down on the back of property sector problems, and it could rebound a little bit faster depending on the policies that will be put in place in the country. And more maybe at a medium-term horizon, not immediately, maybe not for 24, 25, but in terms of what we might see down the road, the artificial intelligence revolution that is taking place offers the chance that there could be a boost to productivity growth, and that would also lift standards of living around the world. Now, there are also downside risks. The downside risks are on the, of course, we know what they are. Supply disruptions could come back, in particular linked to geopolitical shocks. We all read the news. We see what's happening in the Middle East, in the Red Sea. The maritime traffic is being disrupted. Shipping costs are increasing. There could be, it's not the case right now, but there could be some disturbances when you think about oil shipments as well if things were to escalate. So that's clearly a downside risk. Inflation, as I said, it could come down faster, but maybe it won't. And maybe, in fact, services inflation, which is the component of inflation that is still running a little bit hot, could remain so. And so then that would delay a little bit the inflation coming down to target. And then through this episode, financial markets have remained relatively optimistic about the outlook in terms of when central banks might cut interest rates and how quickly we might return to normal. And these financial conditions could change. They could tighten. Markets could all of a sudden become much more risk-averse, what we call a risk-off episode, and that would also weigh down on activity. In terms of policies, what our report emphasizes is that although we are almost there, we're not quite there when we think about monetary policy, and so central banks still have to secure that lending. We have a soft landing in sight, but we're not quite on the runway yet. And then the next big item that's going to be in front of us, that's particularly relevant in a country like South Africa, but it's relevant in many other countries around the world, is fiscal policy. Many countries come out from the pandemic, the energy crisis, with much higher debt levels and also higher interest rates. So the cost of debt is higher and the amount of debt is higher, and that is something that is weighing down on public finances. And countries need to rebuild their buffers, because having that room in front of them in terms of fiscal space is what allows them to deal with shocks when shocks happen, and there will be shocks. That's the one thing we can be sure of. Second, beyond monetary and fiscal policy, making sure that countries implement reforms that will help ignite growth and lift growth above where it is right now. 3.1% is okay, but it's not great. Historically, the world economy has been growing more at a rate of around 3.8% when we look at the average between 2000 and 2019. So 3.1% is significantly lower than that, and we have to think about ways in which we can boost output growth in coming years. And finally, we all see also that we are living in an increasingly complicated world in terms of geopolitical forces that are at play, and some of these forces are leading to what we call geoeconomic fragmentation, separation of the world into different quasi-blocks. And of course, that's not a recipe for growth. And so we need to make sure that we strengthen resilience and multilateral cooperation. So that's kind of the broad overview of the themes we touch in our report. Now let me dive in a little bit and sort of show you some more granular data. So here on this slide, I'm showing you, when I said that the economy was more resilient, on the left you can see the growth surprises in 2023, the third quarter of 2023, and you can see that most countries are above the 45-degree line, meaning that they grew faster than was projected. The horizontal axis is what we were projecting back in October. And many of this, so the red circles here are emerging market economies, and they're sized by their GDP. You can see that a number of emerging market economies contributed to that. At the same time, we're seeing a slowdown, especially in advanced economies. When we look at the G7 and we look at high-frequency indicators, things like PMIs, Purchasing Manufacturer Index, and we look at both in manufacturing or services, or we look at nowcast indicators of growth, you see on the middle that this is slowing down. So the G7 economies are kind of overall expected to slow down, and we see that a little bit in the data as well. And finally, in terms of the geopolitical risks here, what you have on the right is showing you some indicators, high-frequency indicators of some of these metrics for geopolitical risks. So you can look at the geopolitical risk index, and you see that it spikes in the latter part of last year. It was also very elevated in February of 2022, and that's the time of the Russian invasion of Ukraine. You can see that in the blue line, the containerized cargo index, which is an index for shipping cost, is also increasing rapidly, and that's related to the disruptions in the Red Sea. And the dots there in gray, that's U.S. economic policy uncertainty, and that's another risk factor that we have ahead of us. 2024 is it's a global election year. More than half the world's population is going to be going to the voting booth. And of course, that generates potentially policy uncertainty. One of those countries is, of course, the US. Now, if I zoom in on emerging market economies, what we see there is again this theme of resilience. We see it in a number of dimensions. I'm going to highlight a few. When we look at currencies, so the dollar exchange rate for many emerging market economies, you have them on the right side of the first figure. Through 2023 and up until now, what we have is a number of these countries have let their currency depreciate against the US dollar. And this is in a context in which the US dollar, US monetary policy has been tightening, so interest rates in the US have been increasing, and of course that's been attracting capital flows from the rest of the world, and it's been putting depreciating pressure on currencies, in particular in emerging market economies. And you can see that sort of the overall amount of depreciation varies across countries. There is a lot of differentiation, but still there's quite a bit of depreciation against the US dollar. South Africa is to the right there. It's about 16% depreciation against the US dollar since the beginning of 2022. Now, when we dig a little bit deeper, we did some work in our research department, and we tried to unpack the drivers of the movements in the global dollar rate against emerging market currencies. This is the figure on the right, so this one is sort of seen from the dollar perspective, so up is an appreciation of the dollar. You can see is a big part of the drivers of the dollar, the global dollar here, is really U.S. monetary policy. That's the green bars. In fact, global risk in red has been relatively muted, or has been, in fact, going in the other direction. So the financial markets have not been tacking on huge risk premia on emerging markets as a whole, and that's not been a driver of the depreciation of the currencies against the dollar. It's mostly a consequence of what's happening with U.S. monetary policy. And so when we look at instead of looking at the prices now, and let me look at the quantities, if I look at the capital flows themselves, that's a figure on the left, we see a lot of differentiation across emerging market economies, but the big first order lesson here is that capital didn't leave emerging market economies en masse. We didn't have any sudden stop. We didn't have any major crisis in emerging market economies, despite a 500 basis point increase in policy rates in the US. And if you had asked me back in the end of 2021, beginning of 2022, before the US started increasing interest rate, if you had asked me based on my years of working in international macroeconomics and finance and looking at what happened historically, if you'd asked me, look, the US is about to increase interest rates by 500 basis points, what do you think will happen in emerging market economies? And I would have said, well, it's going to be incredibly complicated. There's going to be massive depreciation. There are going to be currency crises. There are going to be sudden stops. There are going to be contagion. It could really be very, very bad. And this has not happened. Emerging market economies have been very resilient. In fact, many of them continue to experience capital inflows. You see the cumulative flows here on the left. Whether you look at emerging Europe, you look at Latin America, you look at Africa, they sort of increased a little bit but then tapered off. You haven't had major capital outflows except flows out of China, and that could also be reflecting other forces than just interest rates moving. It could also be reflecting some of this geoeconomic fragmentation. Now, why is that? Well, the figure on the right provides the beginning of an answer. It's not a complete answer. There are a number of forces. We don't have a single explanation for what's going on here. But what we are seeing when we look at emerging market economies is we've seen a number of them that have improved their monetary policy framework, so the quality of the monetary policy they are implementing and the institutions around the central bank and the frameworks for monetary policy. and also improve their fiscal policy framework. So this, in blue, you have some indicators of the monetary policy framework. In red, you have the fiscal frameworks. And you see that most countries are to the right of the 45-degree line, so they're improved in 2021 compared to 2007. And to us, this suggests that these improved frameworks allowed emerging market economies to be much more resilient in the face of what was, for many of them, a very large external shock. Now, when we look at monetary policy, if we look more specifically at monetary policy, one of the ways in which this improved monetary policy framework manifested themselves is, in fact, many emerging market economies started raising interest rates very quickly and aggressively when inflation started surging, even before advanced economies started raising interest rates, before the Federal Reserve, before the European Central Bank. And you can see that on the left. The left is showing you sort of the number of rate hikes in emerging market economies. That's the dark colors. And in advanced economies, that's sort of the light colors. You see that the dark, I don't know if I have a, yeah, if you look at here, sort of already in the beginning in 2021, before the end of 2021, you had a number of emerging market economies starting to increase rates. The advanced economies were not doing anything, and then they continued increasing rates until the middle of 2022 and last part of 2022, and then really this very strong response of their central banks allowed them also to have to be more resilient in terms of capital outflows. It also implied that inflation dynamics turned the corner faster in emerging market economies. You can see that on the right, headline inflation turning down faster in many emerging market economies than in advanced economies. And they found themselves in a position to start easing monetary policy earlier than advanced economies' central banks. So they were very much on the ball. They were responsive to what was happening to inflation, and they were able to do so, and they were able in the process to let their exchange rate also adjust, and that flexibility was really very important. Now, I mentioned that capital has continued flowing. There hasn't been a sudden stop. We haven't had a major crisis. But of course, it doesn't mean that there aren't vulnerabilities. And when we look at the vulnerabilities we can have here, one of the things we see is the capital flows that are going to emerging market economies, but also other parts of the world, increasingly are passive flows, things like ETF, exchange-traded funds. They are not actively managed flows. And you can see on the left that the share of ETFs in all investment funds, that's the black line, has been increasing from a little bit more than 14%, is now close to 20%. It's been increasing pretty rapidly. Now, what is the problem with that? Well, we also know that passive funds, passive flows are much more responsive to global risk. So if there is a spike, I told you that so far global risk has not been part of the picture. Well, if there is a sudden increase in global risk, then it's likely that these passive flows are going to be much more responsive and could be pulling out much more rapidly. And you see in the middle estimates that we've done of the responsiveness of passive flows, bond and liquidity flows, to a change in global risk here measured by the VIX index. And it's much, much higher for this exchange-traded funds than it is for actively managed funds. When we do scenario analysis, this is something we do in the research department where we put out our projections. We have a baseline projection, but then we look at a number of scenarios and we model them and try to figure out what would happen if they were to materialize. One of the scenarios, I'm showing you two of them here. One on the right is if we have indeed tighter financial conditions in emerging market economies, what would be the impact on global growth, but also what would be the impact on emerging market economies' growth at the horizon of 2025. The blue bars is showing you what happens if you have a stronger slowdown in China. If China's property sector problems become worse, of course, we're all hoping that they get better, but what if they become worse, and what are the spillovers to other economies? In both cases, there is some impact on the world economy, but really the important point is the green diamonds there. The impact on emerging markets is much larger than it is on advanced economies. So these economies remain vulnerable. Now, this is looking at the flows, but now let me look a little bit at the also at the financial conditions, more specifically, and at the long-term rates. What we've seen especially in advanced economies, when we look at financial condition indicators, is, of course, they've tightened somewhat between 2021 and 2023, and that's just a result of central banks tightening policy rates. But they've also been very volatile, and they've been seesawing. And the way you can see this seesawing, and you've seen how the markets, for instance, especially in the US, started expecting the Federal Reserve to cut interest rate very soon. So there's a lot of discussion about when will they start cutting. And the market seems to convince itself that they will start cutting very, very soon, so they get very optimistic. And then financial conditions ease, market valuations increase, long-term interest rates decrease. And so it sort of eases the overall stress in financial conditions. And we've seen this sort of seesawing many, many times in the last year and a half. The last cycle was, from October of 2023 to now. In October 2023, 10-year rates in the US were about 5%. There was a lot of concern about long-term rates. And then all of a sudden, mid-December, the Fed announced that it might be thinking about starting easing rates. And then the market got overexcited about how quickly they would do that. And then financial conditions eased. You can see some of this seesawing in the blue line there. So some of these changes in financial conditions, they could have implications for emerging markets. Now, if you step back a bit and if you look at the long-term rates, it's definitely the case that they've been going up. And so financing conditions have been tightening in many parts of the world, and especially so in emerging market economies. You can see that in the middle chart here. The G20 emerging markets, and South Africa is the country on the right here. You compare the real rates in October 2019 to 2023, and they've gone from about 4% to close to 7% for South Africa. That's a general movement upwards as central banks have been tightening policy rates. So that's certainly something that is making debt dynamics much less stable, and something that is a concern for the future. It's a particular concern for low-income countries. And when you look at low-income countries, this is what you have on the right here. What we're saying is that the increased pressure on borrowing costs basically means that these countries have been priced out of private funding. And instead, what we're seeing now is most of the funding that is coming to these countries is official funding, and there's not so much coming in terms of private funding, and that is increasing the risk of the rollover risk for some of these countries that need to basically go back to the market and refinance some of their debt. I mentioned as a policy challenge, now that inflation is coming down, but interest rates remain high and debt have increased, some of the fiscal policy that needs to be implemented. And just to illustrate this point here on this slide, I want to talk about the need to rebuild fiscal buffers. So on the left, what I'm showing you is the path of general government gross debt as a fraction of GDP for advanced economies, emerging market economies, and low-income and developing countries, and the three lines. And the dashed line is showing you what we had in our earlier projection exercise. And you can see back as of 2019, I believe. And what you can see here is the really sharp increase in debt that happened during the pandemic and the energy crisis, especially so for advanced economies. And that's one of the benefits of having fiscal space. If you have more fiscal space, you can do more to protect households and businesses when a shock of that magnitude happens. Emerging market economies, low-income countries, you see the increase at the time of the pandemic was much smaller. Why? Well, because they didn't have as much room to increase it in the first place, even though their debt levels were lower, but their debt levels are constrained by their capacity to repay. And so we've seen in all three groups of countries, we've seen this uptick in debt to GDP. Some of it came down after that. That's in part the surge in inflation, at least as long as it's not anticipated, is going to erode the real value of the debt. But that's kind of a one-off thing. That cannot be repeated. And then after that, you see sort of the debt drifting up. And that's a concern that we have, us at the fund, is we're looking at these pictures, and the right side here is projections. This is, our estimates based on what government have announced in terms of their fiscal plans, and we see this debt to GDP drifting up, and for many countries maybe getting into a relatively dangerous zone where they would be more vulnerable to a sudden increase in funding costs. The middle chart is showing you not the stocks of debt, but the structural balance, so the deficits, the structural component of the deficits. And here again, we see that they increased the negative numbers here. This is the size of the deficit. So the deficit increased during the pandemic and the energy crisis, and there's been some correction, but not all the way towards consolidating the debt dynamics. And this is why we still have this path sort of increasing on the left. And on the right, we did some exercise where we tried to figure out what countries have announced they will be doing. Those are the sort of the red diamonds compared to what they need to do if they want to stabilize their debt to GDP at the level of that they will achieve by 2028. And you see that many countries, including South Africa here, are below what would be necessary in terms of the primary balances. I want to sort of take a longer perspective here and look not just at monetary policy and fiscal policy for the near term, but I also want to think about the medium and longer term. And here, one of the concerns we have at the fund is we've seen medium-term growth decreasing. It's been decreasing for advanced economies. It's been decreasing for emerging market economies. It's been decreasing for the world. As a result, this is what you see on the left. This is sort of the 5-year out projections growth rates. Have been coming down from a little bit more than 4 for the world to about 3.5, and they've been coming down both for advanced and emerging market economies. But they've been coming down faster for emerging market economies. Now, what does that imply? Well, it implies that the rate at which emerging market economies are catching up to the advanced world is slowing down. It's going to take, if these growth rates materialize, and they've started already, it's going to take much longer for emerging market economies to catch up to the advanced economies' standards of living. And of course, that's a serious problem. So this convergence is expected to slow. That's a serious concern for us, and that is something that leads us to want to think about what are the factors behind this slowdown in growth, especially in emerging market and developing economies. And what we do, if you do a growth decomposition, if you sort of try to unpack what is behind this medium-term growth in terms of accumulation of factors, capital accumulation of human capital, and versus productivity growth, what we are saying is quite a bit of it is coming. I mean, it's coming from a little bit all of the different factors, but a significant chunk is coming from a decline in productivity. The bar that says TFP, total factor productivity here, is contributing quite a bit to this decline in growth rate in emerging market and developing economies. So there isn't as much incorporation of new technologies into the way inputs are being combined in order to sustain growth, and that's a concern. One of the work we've done at the fund, trying to unpack that a little bit further, is to identify reforms that could be helpful in trying to lift growth. And the way we've been thinking about this is there are sort of, bedrock reforms, so we'd call them first-generation reforms, things like governance or business regulation or external sector reforms that are really necessary and are sort of the foundation layer upon which other reforms can really have a much higher, much larger impact. And I'm showing you here on the right the impact of credit reforms. So if you facilitate access to credit, if you open up credit markets, but you've already put in place this first-generation reforms, that's the solid red line, you have a much bigger impact on your economy. You have a 4% higher output compared to the dashed line, which says, well, if you haven't done this foundation layer of reforms in the first place. So there is something there that is arguing the sequencing matters. You want to start with the foundational layer of reforms, the first-generation reforms, and then your second-generation reforms are going to have a much bigger bang for the buck. Now, of course, I mentioned as a medium-term upside risk, artificial intelligence, and that's something that we've done quite a bit of work on at the fund recently, and we're going to do some more. We just released a staff discussion note in the middle of this month that was looking at the labor market impact of artificial intelligence. And really here, the progress, and at least on the technological side, is astonishing. 10 years ago, there was no machine that could perform some of the basic tasks that a human could perform, whether you're thinking about handwriting recognition, language understanding, image recognition, or taking the GRE math test. But if you look at the slope for each of these lines, this is the progress that's been accomplished. The zero line here is sort of the human performance as a benchmark. And now in many of these different tasks, machines are performing at a level that is higher and sometimes much higher than the average human performance. So progress has been enormous, and there is a lot of both excitement and anxiety about how this is going to reshape our economies. The work we did at the fund was looking specifically at how it might impact labor markets, and one of the findings that we have is that it's going to impact labor markets. There are a number of occupations that are exposed to AI, but some of these occupations are exposed to AI. Some of them will be enhanced by artificial intelligence. It will make those occupations more productive. And some of them are going to be, they're going to be competed away by AI. They're going to become, it's going to be harder for these occupations to compete with some of these algorithms or artificial intelligence products. And so we look at both at overall exposure, and within that exposure, we look at those that are likely to be substituted away from by AI, and those that are likely to be complemented by AI. And what we found is overall that there's a very sharp gradient when you look at advanced economies, emerging market economies, and low-income countries. Advanced economies are much more exposed, so there are much higher share of jobs, about 60% of jobs that are exposed to AI. Emerging market economies, it's like the world average, around 40%, and low-income countries around 26%. So low-income countries are not very exposed yet. Emerging market economies are less than 50% of the jobs are exposed, and exposure is higher than 50%, about 60% for advanced economies. But then within each of these groups, the share that can be enhanced by artificial intelligence versus it can be adversely affected is about 50-50. So the picture that emerges is there could be potentially a lot of reshuffling and a lot of transformations happening in labor markets, especially in advanced economies. And as you go down and look at emerging market economies and low-income countries, they may be a little bit more protected, but also that means that they are not necessarily going to get as much of the benefits of artificial intelligence. On this slide here in the middle, I'm showing you one of the countries we looked at is South Africa. We had micro data for a number of countries, and we also can look at the exposure between what I call this low complementarity. These are the jobs that are going to be adversely affected by AI, they're going to be substituted away, and the high complementarity. And you can see that there is an interesting also gender component here, that women tend to be more in jobs that potentially are exposed. Because they are in some of the clerical jobs that are the type of things where artificial intelligence can also make inroads. And finally, on the right, we look also across countries at the degree of preparedness for AI adoption, and that varies a lot. And here we look at indicators that include what happens in labor markets in terms of training of the labor force. We look at the digital infrastructure. In order to adopt AI, you need to have a digital infrastructure that is ready and that is performing well. We look at the innovation sector that can also be helpful in terms of promoting some of these new technologies and adapting them to the situation in different countries. And then also at the ethical environment in terms of what will be allowed, what AI will be allowed to do and what will not be allowed to do. And what you can see here is we get low-income countries and emerging market economies are sort of less exposed, but are also less prepared when we combine all of these factors. And so our recommendation is for emerging market economies to also work on their digital infrastructure, on training their labor force, so that they can benefit as best as they can from this. Final slide, and I will stop there, is one of the theme I've already mentioned is geoeconomic fragmentation. And here, this is something that is sort of unraveling at slow speed. It's not something that is necessarily happening in front of our eyes in a way that is noticeable, but it's more of a trend that is going on, and that trend is already having some noticeable effects on the global economy. So what I'm showing you on the left is the result of an exercise where we put countries in different groups. Now, this is for the purpose of the exercise, and so we put countries in different quote-unquote blocks, and we look at the extent to which trade within blocks has been changing versus trade between blocks. And we look at overall trade, and then we look also at trade in strategic sectors, things like advanced chips and things like that, or trade in low-carbon technology, which is relevant for us because this is necessary if we want to think about the climate transition. It's very important that countries get access to low-carbon technology products so that they can implement a green transition. And what you see from this graph very clearly, you don't need to do fancy econometrics here. You can look at this graph, and what you see is trade between these blocks has been decreasing sharply compared to trade within blocks. And that's a sign of this growing geoeconomic fragmentation that we're seeing. You have more or less the same thing when you look at foreign direct investment. That's the middle chart, where we have less direct investment between blocks. There's a little bit of a decline also within blocks, but here there's an interesting twist. If you have a third category of countries, which let's call them non-aligned, so they are not in one block or the other, they seem to be beneficiaries of that reorientation of trade and financial flows. You see a surge in direct investment. And because these countries become more pivotal in sort of intermediating trade and financial flows. And that relocation risk, in particular, when we look at FDI, is very relevant in many emerging market economies. It's much more so than in advanced economies, and it's particularly relevant as well in sub-Saharan Africa.